And now, The Money Show
with Stephen Grootes on 702.
Let's walk the talk.
The Money Show with Stephen Grootes is brought to you by Absa Corporate and Investment Banking, a Pan-African bank that's invested in your story because your story matters. Good evening. Welcome to the program. A packed day of corporate results. We'll speak to the Shoprite CEO in just a moment, the Discovery CEO, Adrian Gore, after that, Nedbank's Jason Quinn in the next little while as well. Big focus tonight still on American markets, largely because of Trump's tariffs. The Dow Jones is down 1.7% as I speak to you at the moment. The US president due to give another big speech tonight. In fact, I'm sure when you wake up tomorrow morning, that might well be moving markets. And of course, perhaps the big story of the day, really in the great scheme of things, is that our GDP grew by 0.6% in the fourth quarter of 2024, meaning for the year, GDP growth was only 0.6%. The year before, by the way, 2023, it was 0.7%, obviously off a different base because of the impact of the pandemic. There were still lockdowns the year before that. The point I'm trying to get to, though, is just a reminder of how much work still needs to be done to grow our economy. Still, some reasons to be positive, and particularly the fact that load shedding seems to be almost over. Lots to come on The Money Show. You know the number, 011 883 0702 021 446 0567, and voice notes tonight on 072 702 1702.
702. Stephen is on The Money Show.
6 to 8 p.m.
We start with the Shoprite growth story. Seems to be moving up a gear. South Africa's biggest private sector employer announcing today its profits are up by 14% in the 26 weeks to the end of December. Also expanding its 60/60 delivery service from just Checkers stores to Shoprite stores as well. Also growing the list of items that you can have delivered. Peter Engelbrecht is the CEO at Shoprite. Peter, good evening. Thanks for your time tonight. You say in your SENS announcement you increased sales by just over 10%. Where do those sales come from? Are you just seeing increased demand for your products?
Well, the best thing that a retailer can hope for is to grow your customer base. So pleasing for us to say that we've grown customers by 4.9%. We all know they've got choices, and for them to select us, we're very pleased with that. Together with that, also a 6% growth in volume. I did say 6 months ago that if we see a reduction in inflation, I do expect that we will see volume growth. And volume growth is so important for our manufacturers because there are so little tools that they have got to reduce or to curb the costs, the input costs. So all in all, fantastic. And then I cannot help to also say that, there's this common belief with everybody that prices never come down, they always go up. And we went and checked, and then I can confirm to you that 35% of the items that we sell in our business have shown a deflation in the last 6 months. In other words, prices do come down.
I mean, because your selling price inflation across your stores was 1.9%. The official inflation figures were, let's call it 3%. Are you squeezing margins very tightly to get that kind of outcome?
You would have noticed that our gross profit margin actually went up by 30 bips. And I mean, pricing for us is uncompromising. So best value, lowest prices. I mean, that is without question. But it speaks to the investments that we've made around the data, the intel that we have, the AI, for us to determine much more scientifically correct price points, better promotion selections, and that all has resulted in us actually increasing the margin, still being the cheapest supermarket, growing customers. We do invest extra in stock. We run over 98% on shelf availability because we just believe it's just not acceptable that if a customer select to come to our store that we don't have the product. Our customers don't have the money to shop around.
Okay, no, I hear you. You talk about how important inflation has been and the fact that prices do come down. Presumably, if there was a 2 percentage point increase in VAT, that would have quite an impact on demand for you and your competitors.
Yes, without doubt. But for us, it's more critical to give value. That is what we're after. We're always seeking for better value. Hence, as an example, very happy. I hear you're going to speak to Adrian Gore later, but so happy to be able to partner with them on the Vitality program, and we're so pleased that so many people have elected Checkers as their partner, both digital and physical. So we're always just looking for more value, and we do not subscribe to especially cutting value at times when it's really tough.
Your 60/60 service is still growing. You're selling more products through the service. You're expanding to Shoprite branded stores. I mean, presumably there is a ceiling somewhere on how far your 60/60 service can go.
The unbelievable side of this story is every week almost is a new record. Last week we had a new record again on number of orders on 60/60. We've grown 47% on a massive base. Where the demand is definitely not subsiding. Everybody had thought that after COVID we will fall off a cliff with the service, and so it just keeps on growing. We will never go back. So now we've re-platformed. That's a platform, digital platform, and we've added general merchandise. Anecdotally, we joke now to say, you can order your iPhone with your Apple iPhone with your apples and still get it in a 60-minute delivery. You did mention that we are expanding to Shoprite. So we've been in a pilot for a couple of months in 3 stores to see if there's a demand in that sector of the market. It did prove that there is a demand, so we're now expanding it to 19 stores, all provinces, to make sure that we can pinpoint what portion of the Shoprite market it appeals to, because we know Shoprite is the big one. It's got quite a diverse customer profile, and we need to find exactly for who that service will appeal to.
I noticed over the Christmas period, holiday places, Plettenberg Bay is a good example, there was a huge number of your delivery bikes. I mean, are you moving bikes and services to follow your customers at different times? I have vision of a fleet of your bikes down the N1.
But yes, we do up the numbers depending on like an holiday season. So we have moved in Plet in particular. There were drivers moved down there to up the numbers, and then after the season we will take them or reallocate them again somewhere else.
Peter Engelbrecht, thank you very much indeed. The CEO at Shoprite, really one of the most incredible growth stories of recent times in South Africa.
The Money Show
with Stephen Grootes.
The financial services group Discovery boosting its interim dividend by 1/3 after reporting a 34% increase in headline earnings for the half year to the end of December. The group also saying its bank, Discovery Bank, is still making a loss but did turn a monthly profit for the first time in December, while the Discovery Health Medical Aid Scheme still has just under 60% of the medical aid market. Adrian Gore is the CEO of the Discovery Group, joins us now. Adrian, good evening. You launched Discovery Bank a little while ago, making a monthly profit for the first time in December, increasing revenues by 42% over the last year. I presume some of that is maybe ahead of your expectations.
Yes, it is. I mean, Discovery Bank has had an unbelievable evolution in the last 6 months. Have shot the lights out. So we're kind of ahead the capital plan by about $1 billion rand, which is good. But the actual every dimension of the bank has performed better than expected. The bank is now profitable, and profit should grow, in size and in cash profits. Needs little capital going forward. So we're kind of on track for real growth. Also, I'd say, Stephen, the actual, ignoring the numbers, the receptivity, the usage of the bank, the kind of survey results, the anecdotal kind of narrative around the bank has been unbelievable. So it really has been a star of the show, despite I think the good performance of all the companies.
I mean, the banking market's getting more and more crowded. It's Old Mutual are launching a bank. There are others. Are you going to be able to retain market share, attract new market share? I mean, it might take a little bit more than just a faster trip through the airport security to keep customers.
I think it's a good question. I mean, the reality is that 65% of new clients to the bank are not Discovery members. So, we're getting into a pretty broad market, which is really good, not just for the bank, but for other products that then, function well with the bank. But the market is really big. We've got, over 1 million clients, 2.5 million accounts. It just seems the growth continues, and the quality of the growth is kind of really good. So if you look at what products they're buying, the credit loss ratio, it's all exceptionally good. We've seen that accelerating, not slowing down. I also think we haven't, it's a digital bank, but it's a full service bank with some physicality. So we haven't gone the route of how can I say, of kind of these skinny banks that think you just need an account or a payment system. It's a full service bank that offers ecosystems, and you'll see AI coming out of it quite soon, and a number of things. I think we're very confident in our ability to, in fact, accelerate the growth.
Your health business doing strongly again. Obviously, lots of talk still about NHI. Still huge demand for private healthcare, and people still insuring themselves for healthcare in case they need it. I mean, obviously, demand there just continues.
This is the paradox. I mean, there's this very complicated, noisy debate about NHI, and that will go on. This is a decade-long process, and despite all the issues and court actions, I think we'll land ultimately in a rational place. It has to. I think the demand for healthcare and private healthcare will increase, not decrease, if anything. And the point we try to get across in our presentation earlier is just people shouldn't underestimate the quality of the private healthcare system, or what a national asset it is in terms of quality of doctors, hospitals, an egalitarian funding system. So, our role is to make it affordable, not easy at all to keep inflation down. It's a real battle. But instead of all the negative kind of NHI discussion, we need to think about how to grow it, how to build it, how to make the system with NHI workable. And we think we can.
I mean, you run a similar business in the UK nowadays. Their government is having problems with their National Health Service. I presume you're seeing quite strong demand there too for private healthcare, and all of these debates feed into each other.
It's an existential problem. Every government has fiscal constraints. You've got aging populations in many parts of the world, increasing chronicity, and all of that leads to more healthcare demand and less money to pay for it. So these debates happen all the same, or they manifest in different ways, but typically it manifests in high levels of spend, in complex, inflation problems, and in solutions, if they work, that really scale. And that's what we've kind of seen with Discovery Health, and we've seen in the UK, and we've seen in China. It's the same issues. So they come with different ideologies, different kind of contexts, but you've always got increasing demand with limited resources, and that's the problem that we have to solve.
You've spoken several times in the last few months about the state of our economy. That will obviously determine demand for your services. You were quite optimistic towards the end of last year. The situation around the Trump administration might have changed the views for many people. Are you still so optimistic for South Africa?
I've never been naively optimistic. My view, and from my own, so many people I think share the view, is that the country has incredible potential and often it's underrated, and we should be activists and work hard towards building it rather than just being critical. And I actually think, the business-government partnership that we've had, which collectively has brought Eskom into a better phase and has somewhat alleviated load shedding. It's bumpy, it will come back now and then, but in the main, it's kind of gone, I think. It's been remarkably successful. I do think that we got a very different narrative post the election and the GNU. The Trump administration and some of the stuff coming out of there now creates a much different set of dynamics. I mean, I still believe we shouldn't be deterred. We need to focus on kind of holding the middle, focus on building the economy, focus on the stuff we know turns the fulcrum towards economic growth and jobs. That's all we do. And everything we do, I think, should be about trying to build a narrative, trying to create economic growth, and trying to create jobs. We should do nothing that deters from that. Every single decision we make should be based on that. And I think that's the way we've got to navigate this incredibly difficult environment. But it will be bumpy for sure.
I mean, you're part of business for South Africa, and as you say, it will be bumpy. I mean, frankly, I think that we may need to prepare now to no longer be part of AGOA. Would you be willing to go and convince the US President Trump that he's misunderstood the situation in South Africa? If the President tapped you on the shoulder and said, will you please go with this delegation of South Africans from different parts of our society?
Well, I think there's a very good dialogue in organised business around this, and I think there's good dialogue between government and business around these issues, and I think there will be a lot of diplomacy and views taken. You can see what happens, and ignoring what the issues are, it's not always predictable, the outcome. You've seen what's been going on. It's not a simple thing to do, I don't believe. But I still do believe we must be focused on putting the country first and on, as I say, economic growth and jobs, and telling that story appropriately. I think we mustn't be deterred on side issues and whatever. And I think however we do that, diplomacy that has to come across in the right way. I felt pretty good, when we got to Davos and telling the story of South Africa. It was a good story, and there's been a different narrative forming about the country. We have our issues of internal differences of opinion about all these policy issues. We have complicated laws, NHI, expropriation bills, etc. But there's some middle line where the middle holds and not letting the extremes take hold, and find our way to actually finding solutions. And I think that's how we have to work. That's how we have to communicate. I don't pretend to have solutions, Stephen, at all, or the what's the word, the golden thread. But I just believe the centre has to hold. And we must build the centre. Don't let the extremes pull either way. That wouldn't be good.
Adrian Gore, thank you very much indeed, CEO of Discovery.
The Money Show.
The Markets.
Kwena Maloko is Equity Research Sales at Absa CIB. Kwena, good evening to you. Let's pick it up with Discovery there. One of several corporates today announcing really strong earnings, and particularly Discovery Bank doing better than expected at quite an early phase.
That's completely right, Stephen. I mean, some big numbers we're seeing here, right? 27% increase on operating income, 34% increase on headline earnings, right? And like you said, the bank itself finally profitable. But I think what's important for me is, yes, they've sort of smashed the targets for 2026 in terms of customer numbers. So they're already at 1 million this year. The thing that stands out for me is that the fee per client continues to go up. So not only are they signing up people are engaging with the products and using them, which sort of sets them up in bank for some very good growth going forward.
I mean, banking is going to get so interesting because there are going to be so many of them.
We are seeing a lot of credible challenges, right? So there was the threat of the neobanks coming in, but now we're seeing some big houses with big capital willing to enter the market. So again, it's always interesting. I mean, the last time there was big competition in the banking sector, we got Capitec. So let's see how this turns out.
Good time to get a mortgage. Shoprite, I mean, I found this astonishing. I mean, you hear the CEO, very bullish, and so he should be. They've done incredibly well. And if you consider the size of it, I mean, South Africa's biggest private sector employer, growing profit by 14%. That's moving the needle a lot. The market didn't seem to like it. I was a bit surprised by that.
Yeah, the share price was quite surprising, right? So ended the day about 3% lower, but it had initially been up 2.5%. And I think one of the ways I like to put into context is, for the longest time last year, it had the clearest sort of investment case. So between it and its peers, it was quite difficult to go anywhere else. So maybe a little bit of profit taking that I'm seeing. But I think another thing in the result that stood out for me again is the CapEx number. They talked about 8 billion rand that they're going to invest just this year, right? Behind technology, new stores and refurbishing stores. So while the growth is solid now, it's quite pleasing to see that they're still willing to invest so much for growth longer term.
There's something about the science of shopping. And they seem to have won that argument, as opposed to, and I mean, Boxer will come up strongly, I presume, and Spar claim to have sorted out some of their IT problems. I mean, but the science of shopping is the competitive advantage here.
That's correct. I think they call it precision shopping, right? So I think they've invested quite a lot of this. And 60/60 has helped quite a bit. They now understand their customer. They know exactly how to promote and who to promote for. So I think these numbers are quite strong and probably are with us for some time.
Nedbank, we'll speak to their CEO, Jason Quinn, in a few moments. They had strong results, still announcing a little bit of a restructuring, though, which seemed a little strange considering how strong their results were.
Yeah, I mean, the result was quite strong. I think the most pleasing part of it was the impairment charges, right? The last couple of sets of results were a bit disappointing because the impairments were still quite high. That's come down quite nicely. And as you can see, at least this one closed up for the day about 3% I think the restructuring comes in at a time where they're looking more medium term. The short-term problems seem to have resolved themselves. All the markers are going up, including ROEs, but they do have an ROE target of 18% in the medium term. And for them, this restructure is one of the ways to get there quickly.
Kwena Maloko, thanks very much indeed for coming in. Equities Research Sales at Absa CIB, bringing the time to 6:30.
The Money Show
With Stephen Grootes, live on 92.7 and 106 FM. Streaming on the Prime Media Plus app.
and DSTV channel 856.
Well, you know the number 011-883-0702-021-4460567. Just to update you on American markets right now, and of course taking the pain from Trump's tariffs, the Dow Jones down 1.9%, the Nasdaq down 1.5%, the S&P 500 down 1.7%, and I fear there's perhaps more to come. The US President Donald Trump saying today on Truth Social, his social media network, that he believes American banks are not allowed to operate in Canada while Canadian banks are allowed to operate in the United States. Of course, I say this slightly warily, you know that is not true, and American banks are absolutely allowed to operate fully in Canada, and in fact are in large numbers. But that, of course, just plays into the narrative he's creating around tariffs at the moment. We do expect a lot more. We do expect also that he is going to speak at around, I think it's 4 o'clock our time, 9 p.m. Eastern time in the United States. He'll be setting out his international and domestic agenda. I suspect I know what we'll be talking about tomorrow.
702. Stephen is on X.
At Stephen Grootes.
Well, more cheerfully, news from Nedbank this morning. It will be restructuring some of its divisions, create a personal and private banking division out of what are currently its retail and business banking and Nedbank wealth unit clusters. The group reporting strong results for the year to the end of December. Headline earnings up 8%. Off the back of a slightly stronger economy. The CEO of the Nedbank Group is Jason Quinn. Jason, good evening. Your earnings are up nicely. Things seem to be going well. Clearly, you feel you still need to make some changes.
Yeah, Stephen, thanks very much. Great to be with you and your listeners this evening. I think that's right. You know, we put down a pretty good set of numbers today against a very tough macro backdrop. And it was only towards the end of last year that some aspects of the economy started to pick up. But no, look, I mean, we at Nedbank, we want to build out scale. We want to serve our clients as best as possible. So on the back of the good results, you know, we had to look at everything and thought, well, we could do a little bit better with the way we focus on our customers. So everything we spoke about with respect to that restructure deals with getting customer centricity, improving our cross-selling, our upselling, getting new customers into the organization. And nothing more than that. So this isn't a cost efficiency play or anything like that. It is merely to reorganize ourselves to serve our customer segments better.
It's a science of banking thing. We spoke to Shoprite earlier. There's a science of shopping thing. This is the science of banking.
Absolutely. You know, it is actually all about colleagues and customers in banking. Of course, you know, we've invested heavily in technology and really pleased that we concluded that managed evolution of our core banking last year. But Stephen, we've got so much more to do to digitize our processes, you know, make banking easier for customers. But at the end of the day, also, we have to be, you know, present with them and serve them with the human touch. And I think that speaks a lot about what we're talking about here in terms of, you know, just we've got really good net promoter scores as it is, but we don't rest on our laurels. Like, we really think this reorganization just puts the customer at the center of everything. For instance, in our personal and private bank going forward, it'll have, you know, not only the customers right from entry level through to wealth, with differentiated offerings, differentiated brand propositions, but within that we'll have all of the distribution, all of the product, including insurance, and all of the coverage in one place.
Nedbank Corporate and Investment Banking grew its headline earnings by over 9%, a significant part of your bottom line in this, I presume. What drove that growth so strongly?
Well, look, we've been really good at infrastructure, everything related to infrastructure for a very long time. It's part of our DNA. So we saw, better client activity towards the end of the year. And Stephen, thankfully, we also finished last year with a very strong pipeline in areas such as renewable energy. So it's all of that, our risk management capabilities where we provide clients with protection on fixed income and currencies, commodities and the like, equities as well, all had a pretty good performance. And still opportunity there, Stephen. So although we're not doing a reorganization there, CRB will get oversight of our asset management business going forward, of course. But we still have a corporate transactional business that we think we can build out. And we still have, real strengths like in infrastructure that we think we can use to expand into East Africa in areas that we're strong at. So a very, very deliberate and targeted approach towards continuing to build out our really good CRB business.
Not a great picture at Nedbank Africa in your region, in your Nedbank Africa regions. Earnings there down 14%. Some of the markets, Zimbabwe, Mozambique, Eswatini. Problems there?
Well, there's one specific thing to highlight is that within that number, Nedbank took a gain in the prior year on the release of a provision related to Ghanaian bonds. So that was kind of a one-off gain in the prior year. Excluding that, it's a bit closer. But it's fair to say that, we continue to see our NOR or African regional operations as an opportunity going forward. We also said today that we're busy completing or finalizing a strategic review of our ETI investment. And I think that'll be important as well.
Looking at the outlook for our economy, a lot of confidence last year, some of that abating a little bit now. How are you feeling about the South African economy? Obviously, that would have a big impact, and we're still waiting to see what happens with interest rates, although we kind of have a sense. But are you feeling a little less confident than maybe you were 6 months ago?
I'm still cautiously optimistic, Stephen, and I'll tell you why. So we never factored in a dramatic rate cutting cycle. We always had a fairly shallow cycle, and I think we're seeing that play out. But there's so many base effects in our economy in the prior years, particularly energy shortages and the like, that I think naturally give us a bit more boost into 2025. Now, I guess we're all looking for more proof points, public-private partnerships, infrastructure investment. These are all things that Nedbank's good at and would be, very keen to participate in. And so we just need a bit more of that to kind of boost us. But we kind of see loan growth picking up this year. As those rates come down, growth picks up. But I would say, Stephen, that it's probably back-ended this year. I think half one, we may not see that momentum yet.
Okay. Some changes to your executive team for various reasons. Nomonde Hlongwa will be your new Chief Compliance Officer. There are one or two other changes. We've seen, and Jason, you had a very close view on this, but you can see what happens at a bank when there isn't a proper pipeline of talent and leadership talent in particular. Are you confident about the leadership pipeline at Nedbank?
Absolutely. Stephen, I've got no doubt about the colleagues and the strength of their capabilities here. I find an energized group of colleagues that really want to serve customers well. So those changes, really, the Chief Compliance Officer, Dillian du Toit, reached normal retirement age, and we announced her replacement today, well in advance. Orlando Ruggiero, who led our wealth business, also is taking early retirement, won't be replaced. And then there's a new vacancy in the organization to lead our business and commercial bank. But I'm pleased to confirm that Tico Thomas, a long-standing executive here, will be leading our personal and private bank going forward. So although, of course, there's change, but that does create opportunity to see the next layer of talent in Nedbank emerge, and there's lots of them.
Jason Quinn, thank you very much indeed. CEO at the Nedbank Group. Really do appreciate the time. Thank you. Jason Quinn, of course, if you recall, if I remember correctly, was headhunted from ABSA to Nedbank. And of course, you saw what happened at ABSA after all of that. 9 minutes now to 7.
The Money Show with Stephen Grootes is brought to you by ABSA CIB, a Pan-African bank invested in your story and the potential it can unlock because your story matters. ABSA is a registered FSP.
7 minutes to 7 the time. Well, amid all of the corporate results and the fact that US markets are still pretty much sinking like stones, was the news that our economy grew by just 0.6% in the fourth quarter of last year, meaning our economy's total growth for last year was in fact just 0.6%. You might remember, by the way, that sort of shock contraction in the third quarter of last year caused by a massive drop in numbers in agricultural production that did lead to some talk about the quality of data provided to Stats SA on the agricultural sector. Ndumiso Kubeka is the chief economist at K8 Research Equity Partners. Ndumiso, good evening to you. To see fourth quarter expansion of 0.6% and really growth below 1 percentage point, or grow below 1% rather, for the whole of last year, I suppose it reminds us of how deep our economic problems really are.
It certainly does, Stephen, and good evening. It certainly does. And the same trend continues to be consistent, even when we look at the output for 2024, even when comparing it with the output for 2023, that we do have an aggregate demand issue. And that is both reflected on the household expenditure side, which is very moderate if you compare both 2023 and 2024. Even on the side of public investment, which is where we typically are able to sort of forecast in terms of what our economic fortunes look like over the short term, even that is also quite muted. And so it certainly continues to show that accelerated reforms need to be in place. But more importantly, we really do need fixed investment going forward in order to change our fortunes in the near term.
We heard from the CEO of Shoprite a little earlier in the program saying that because inflation was lower, they had a lot more demand and thus they sold a lot more goods. I say this because we still don't have a budget and we still don't know if there's going to be a VAT increase, but we know a serious one was proposed. Obviously, all of these things would have an impact on what we're trying to do, which is to grow the economy.
They certainly do, Steve. And I think over the years, oftentimes we've heard, colleagues and many other analysts make reference to the fact that the South African economy or the South African consumer is quite resilient. That is actually attributed to the fact that over 60%, almost 70% in fact, of our GDP is actually driven by consumption spending. So if you were to compare that, for instance, with an economy such as China, which consumption spending only accounts about 39% of their GDP, they are largely driven by public investment. South Africa's GDP growth is typically similar to that of other advanced economies. And so when you find what is currently happening in terms of externalities with the geopolitical trends that are currently taking place, you actually find an economy such as that of China being vulnerable because of the externalities of what's happening in terms of international trade policies. But economies like ours, which are largely driven by consumption, tend to be able to offset those kinds of externalities. And so that's why I think when the likes of Shoprite released their results, and even despite a very difficult climate, you still do see some of those retail sales numbers being resilient. It's because our economy is really largely driven by consumption spending.
The fourth quarter, the 0.6% in the fourth quarter last year was driven up by agricultural production, and there were questions about the agricultural productions in the third quarter, and it was that sector that led to us actually having a shrinkage in the third quarter of last year. Should we be comfortable with the quality of the data Stats SA is dealing with in the agricultural production sector? Because it did seem and certainly caught many people in the agricultural sector by surprise in the third quarter last year.
You're raising such an important issue, particularly because of also having made reference to the questions around the budget. Over the last couple of years, there have been some concerns that have been raised regarding the real decline in terms of allocation towards Stats SA and the resources that it requires. Now, unfortunately, it tends to be reflected when we see some questions around some of the quality of the data that we receive from a quarterly basis or a month-on-month basis. And so this is indeed an area that I think should receive much attention, because this data is in effect what we use to forecast, is in effect what we use to also put forward important policy positions that will ultimately should benefit all South Africans in the near term and going forward. And so this is particularly quite important, even as it relates to the agricultural sector, because with some new research that has also come out, one of the things that have come out quite recently is the fact that an economy such as India has indeed been able to flatten extreme or chronic poverty, and that is largely attributed to the role of agriculture. And so when you have an economy like ours, which is also quite struggling on the manufacturing side, agriculture becomes an important industry to look for. So the quality of the data that comes out of there becomes quite important. And so we would hope that even in the upcoming budget, we would see some decent allocations towards important institutions like Stats SA.
I mean, and they've been very upfront about their budget issues over the last few years. Ndumiso, at one point, the Reserve Bank said load shedding was cutting 2 percentage points of GDP. Can I ask the governor, where is my 2%?
Well, perhaps it might slightly be a bit too early to ask the governor that particular question, particularly because I think we've seen somewhat of a sustained period of no load shedding in 2024. Which has indeed, we've seen that permeate slightly in terms of the business confidence numbers that have been coming out and also the consumer data that has been coming out. So typically we see that as a lagging effect in the data points. Now, of course, now with what's presently happening, I'm sure there'd be some level of moderation where that is concerned. And so, but this also is an important reflection on being able to meaningfully resolve these structural bottlenecks as a base case, so that at least we know that once these structural bottlenecks are indeed sorted and we are comfortable that they're sorted for good, we at least have a base case of 1.5% plus. And so that, I think, then is something that we can then be able to build on other reforms that are able to take advantage of that solid foundation.
And Ndumiso Kubeka, thank you. Really good to hear your views. Chief Economist at KH Research Equity Partners, bringing the time to 7 o'clock.
And now, The Money Show
with Stephen Grootes on 702.
Let's walk the talk.
The Money Show with Stephen Grootes is brought to you by Absa Corporate and Investment Banking, a Pan-African bank that's invested in your story because your story matters. Good evening. Welcome to the second hour of the program. We talk about the US President Donald Trump in just a moment. His comments, tweets, actions having a big impact on international markets. Markets on Wall Street down quite significantly today as I talk to you tonight. And of course, more to come. He's due to give a big speech in a little while. We'll get an update on some of the business activities on our continent from Dr. Rutendo Ndwingwi. And then we'll speak tonight about personal finance rules you can actually live by. In other words, if you look at everything that's going on around you, how quickly things are moving, how difficult some of it is, how tricky it is to navigate, just a few simple rules to actually get through. In other words, how to sort of, if you can manage yourself. And it goes back to one of the old things, you know, you must control what you can control. Now, I can't speak for Warren Ingram, but I certainly hope that he'll be nodding his head as he listens to that you do need to control what you can control. And if you can't, well, then you need to control for that as much as you can. All of that, of course, not necessarily as easy as it sounds. Just thinking a bit more about all of the corporate news that we've had, and it is astonishing in a way that you can have big companies like Discovery, like Shoprite, which employs a very large number of people, that you can have companies like Nedbank producing and reporting such important profits, such good substantive earnings, and yet our economy just does not seem to be growing in any significant way. I mean, 0.6% is not really growth. And if you look at the number of people coming through the system, it's no wonder that so many of the people you know and see and talk to and hear about, maybe in your family, who are not able to find a job are younger people. I mean, it is no surprise at all. What we still don't have, I suppose, is any kind of certainty about how, if, when this is going to change. And I mean, I'm just describing, I'm not saying anything new here, I'm just describing the South African condition, I suppose. What I would say, though, is that some unity from the coalition government on this would be a very good thing. I just don't hear enough about the economy. And yes, if you ask people, they will talk about it. But none of them really come out and say, this is what we're going to do and this is how we're going to do it. And at a time when we're still awaiting the budget, there was a statement from Cabinet early this morning saying that, as I understood it, the sort of big issues have been resolved, sent back to the finance minister. He had been given certain options to pick from, and off we go. The DA, if I heard an EWN saying that no agreement on the budget has yet been reached. It's next week. there is a huge amount of money that needs to be done once agreement has been reached. And I think this is something that we really do need to take very, very very, very seriously. And I think that is one of the issues that, really we don't spend enough time talking about or actually expecting to actually manage. It is something that, unfortunately, is likely to become even more complicated because of what is happening in the United States. And I've made this point to you before, and I suspect that I'll have to make it again. We probably have to expect that, in fact, we are going to be removed from a go. If you look at some of what's coming out of the United States, I think that is a rational presumption to make. And there's really very little we can do about it. This is about American politics. It's not about us. We mustn't expect that we can change the outcome, that we can do anything about it. It is about politics in the United States. And until that domestic picture changes, nothing coming out of the White House is going to change. And I think that is something that we are just going to really have to deal with. In the meantime, of course, we have some great companies and they seem to be doing relatively well. And we should, when we can, sort of celebrate how well they're doing and how they're doing it and why they're able to make these things change. 011 883 0702 021 446 0567 and voice notes tonight on 072 702 1702.
The Money Show on 702.
Monday to Friday, 6 to 8 p.m.
An awful lot going on around the US President Donald Trump. He's due to speak at a joint session tonight and basically stake out what we understand will be his domestic and international agenda. He, in the last couple of hours on Truth Social, has questioned what he says is that Canada does not allow American banks to operate in Canada. He's lying when he says that, by the way. China and Canada and Mexico all responding to the tariffs that have been imposed by Trump. And in the meantime, markets on Wall Street down significantly tonight, I presume, ahead of a big speech he's due to give at 9 p.m. ET, Eastern Time in the US, around 4 o'clock our time. Howell George is Director of Investments at Old Mutual Investments. Howell, good evening to you. International markets already showing they don't like new tariffs from Trump. A little bit of trepidation ahead of what he might say tonight. I don't get the sense, though, that Trump is listening to markets. Could this just be the beginning of a very difficult new era?
Yeah, good evening, Steve. Good evening to your listeners. Yes, markets are entirely nervous at the moment. I think they were slightly looking for an excuse to just have a correction. They had been on a very strong run post the Trump election success, and Trump is generally pro-markets, and we saw the markets run. We saw the dollar run, we saw crypto run. So it's all kind of unwinding from that point of view. But it definitely does inject a lot of uncertainty. There's a reasoning behind all these tariffs, and it may not fully come to pass. And we're happy to talk about that. But in the meantime, yes, it's gonna make the market nervous in the short term.
I mean, it's such a great time to have this conversation. I mean, China I get, but Mexico and Canada, I mean, clearly he's trying to, I presume, show to his constituency he's trying to keep jobs at home.
Yes, but that's the Chinese play. I mean, there's a $300 billion trade deficit with China in China's favor. So that's an economic play mostly. It's partly a geopolitical play, but mostly an economic play to bring that deficit down, ideally, if he can. And that's a play to the domestic audience. The Canada and Mexico is really a geopolitical play, partly extending Trump's sphere of influence in the locality, and partly, of course, trying to secure the border to an even greater extent and stop fentanyl coming in, particularly from Mexico. So he's using this time tariffs as a geopolitical lever in certain instances, as opposed to an economic lever. So it should be framed in that sense.
I mean, one presumes it's not just going to be these three countries. There will be others, and all of them are going to have to come up with some kind of response. And I've been fascinated by the kind of calibrated nature of the response from some countries. China's announced more tariffs on US goods, imposed export restrictions on others. Canada, perhaps more calibrated than all of the others, tariffs on some American goods and more tariffs if the US tariffs are not lifted.
Yes, well, Trudeau's trying to play the Trump game now from the Canadian point of view. I mean, they're a much weaker trade partner than America, obviously, but let's see how he gets on with that. But if you look at the ones in the crosshairs, you've got $300 billion deficit with China. You've got close to $300 billion with the European Union. They'll be. You've got about Canada's quite small at about $60 billion. But then you've got places like Vietnam, Taiwan, South Korea, all running a big trade point of view with the States. So it is also a geopolitical play. We mustn't forget that. That's different to the last time around in 2017. And this is about Trump, extending his sphere of influence.
I'm afraid.
Across the North Atlantic, United Asia.
It's not a great line, and as you know, we're having difficulties with this, but for an economy like ours, any tariff is generally bad news. I can't imagine there's much our government can do to prepare for this difficult new era from a South African point of view.
Yes, it is.
I think we'll have to leave it there, I'm afraid. Howell George is Director of Investments at Old Mutual Investments. Sorry about that.
The Money Show.
The Africa Business Report.
With Dr. Rotendo Hundengwi, the founding director at Tribe Africa Advisory, also author of the book Rumble in the Jungle Reloaded. Rotendo, good evening to you. Good to talk to you tonight. The UAE and Kenya, they've got a nice big trade deal. Are we going to see more investment as a result?
Good evening to you, Steve, and good evening to your listeners. And this is an interesting dynamic, bearing in mind what's happening globally with the geopolitics and the geoeconomics. Kenya, the seventh largest economy in Africa, it's got a GDP, Stephen, of about $139 billion. It's signed what you call a comprehensive economic partnership agreement, CEPA. And the key elements of the trade, Stephen, and before I talk about the key elements, I think just to highlight two things about Kenya. If you recall last year, Stephen, there was a big uprising in Kenya. There's Gen Z went on the streets. Why were they striking? They were striking because there was a new tax increase that was supposed to happen. I think it was VAT related. And the reason for that was the IMF was wanting an increase in its payback from the Kenyan government. So it was a ripple effect of a loan that had to be paid back. And Ruto was trying to adjust for that, led to the strikes. So he's gone to look for partnerships elsewhere. And one of those key areas is the UAE. It's two countries have probably about 10 years of trade. They've done about 3.5 billion. It's doubled over the years. Kenya will be exporting mainly meat, fruit and vegetables and flowers to the UAE, whilst the UAE will be exporting petroleum, machinery and chemicals. So it's a win-win, which is great. And over and above that, Stephen, he's been able to secure as well some financing to pay back debt, because they owe about Kenya, they owe about $6 billion to China. So they're trying to look for friends in different places, and they found friendships within the UAE space, which resolves their problems in the interim. It's still to be seen in the long haul, but there's a lot of play happening in the Middle East, and there's another $500 million as well, Stephen, that they've got from the Abu Dhabi guys. So a lot of activity happening in the UAE space between themselves and Kenya, not just in terms of financing, but also in other sectors as well.
I mean, there's a lot the UAE would like from other countries on our continent as well, agricultural products in particular.
No, that's 100%. And bearing in mind the UAE or the Middle East space, Stephen, is mainly desert. So for them, they've got the oil, they've got the money, but they also need the food. So you can actually see they've been very strategic in terms of partnering in Africa. And I think they're finding a gap because they've kind of analyzed the challenges African countries have with the US or the West, and the kind of challenges they have on the East as well with countries like Russia and China. So they're quite strategically positioned to be able to come up with a value proposition that's a win-win. So if you look at the other investments that the UAE or the Middle East is making in the African space, and in terms of investment with regards to be given opportunity in terms of getting agri-products from Africa, one big player is Majahid Al Futtaim, which runs the Carrefour retail investments on the African continent, and the Amir Power from Abu Dhabi, as I mentioned before, they invested about $500 million with regards to the energy space. And they're doing this thing, guys, we need agriculture, we need flowers, we need things that we can't grow in the Middle East. Let's make this a win-win. You think of DP World on the port side and how that's been strategic. And I think the Middle East players are becoming, if not the leading infrastructure investors on the African continent. So Kenya is leveraging off that, bearing in mind the challenges it has with the West and the East in terms of debt. So it'll be good to see how it plays out. But again, I think it's a nice win-win story under the circumstances and the way geopolitics are playing globally, Stephen.
A lot of conversations over the last few years around how aid could be reimagined. There's an opportunity here.
There is. I mean, the big thing that has triggered this conversation is obviously USAID pulling out, or the US pulling out the investments or the aid it was supplying through Africa. And the rest of the world. But from a numbers perspective, Stephen, just to give context, last year, USA spent, or in the year 2023, USA spent about $72 billion in foreign aid, and $40 billion of that was specifically USAID money. 19.4 billion of that 72 went to Ukraine. So to a certain extent, you can understand why Trump is unhappy with spending more money with regards to Ukraine. But when we come to Africa and we zone in on Africa, we actually received a smidgen of that USAID or that aid from the US. Egypt and Ethiopia were the two biggest recipients, and they received about 3.2 billion. And the leading other countries besides Ethiopia and Egypt was DRC in Nigeria. And I highlight these two because they are big economies and they shouldn't really depend on aid. But having said that, I think the argument with regards to aid is that it hasn't translated into industrialization, into growth economically in the way people would have expected it, especially over the years. And that's the reality of aid in Africa. Whether it's for political reasons, whether it's for maladministration, the list could be endless. And the argument that is coming to the foreplay now is that we've been forced to say, okay, guys, we've been receiving plus or minus $10 billion of aid over the years. How has this really translated into economic growth? And the questions are saying, now that it's no longer there, what can we do by ourselves? And one statistic, which I think is a potential solution, Stephen, that I'd like to bring to the party, is that the World Bank said that last year alone, and this is the year 2023-2024, $100 billion of diaspora remittances came into Africa. And this has exceeded both ODA or developmental aid and FDI. So in other words, Africans in first world countries are sending $100 billion home to loved ones, for relatives, for health, education, etc., etc. So the question is, we've got money coming into Africa from Africans. How can we utilize this to address the issue that's at hand that aid was been contributing before? And this is it's not an intellectual discussion, it's actually a practical discussion. Sure. And I think there's a lot of opportunity from Africa, and these are some of the debates that are going around under the current geopolitics and geoeconomics.
Obviously, energy, big part of that. A lot happening around the Africa Energy Bank.
No, Africa Energy Bank, and this is an idea, it's coming also out of the frustration. So if you start ticking all these dots or putting all these dots together, it's obviously a lot of it is coming out of the Trump 2.0 saga. Some of the ideas, like the African Energy Bank, which was probably formulated some years ago, and the three big players that are coming, who are putting their minds around this is Nigeria, Libya, and Angola. African Bank is coming to the party as well to support them. And the way the idea came out, Stephen, is that obviously with the Paris Agreement, a lot of the FDI that's coming into Africa for anything that's energy related is saying the energy must be clean energy. But we know Nigeria, Angola, and Algeria are some of the key countries in Africa that still depend on oil as an energy. And they've come together and said, guys, why don't we put a bank together? We need about $120 billion of capital in the next 5 years. What we need to do so that we don't have to depend on foreign aid in order to achieve that. So the sourcing of the funding for this idea, which is very noble, and I think if it does take off, it's great for the continent, is sovereign wealth, commodity traders, and international banks. And a lot of thought and planning has gone to it. Some of the other smaller oil and gas players on the African continent are also jumping on board. And for me, I know there's always been the idea of the BRICS Bank, which is very politicized, but I think an Africa Energy Bank practically is more feasible because the money is already there from exports, and it's just a matter of channeling it and putting it into a capital asset that can grow.
And then there's been another big oil discovery in the Orange Basin in Namibia. I mean, that could be very exciting for the entire region.
Yeah, so Stephen, this is through Custos Energy, which is an indigenous player. That's also exciting because it talks to Africa industrialization and investments being made by the country in terms of or the continent in terms of developing itself. Namibia is making significant inroads with regards to attracting investors on the continent. Last time, if you recall, I mentioned Shell had done an exploration and they had sunken cost about $400 million, and they walked away from that because they didn't see the gas or the oil that they needed to see. But they said we'll continue investing in Namibia because we see the potential. Here's one which is actually another opportunity that has come up where they discovered energy, and it further cements the area itself is called the Orange Basin. And there's there are deposits of hydrocarbon that they've discovered. The energy sector in Namibia contributes to 9% of their GDP and is growing year on year. So it's got huge potential in terms of growth. It's attracting investors. And obviously, we're with Namibia in mourning because they buried their former liberation hero and the former Prime Minister of Namibia, His Excellency Sam Nujoma, over the weekend. But still, the country is in a good position and they're attracting the right investors to make the right impact in the region. And that will obviously significantly make a difference on the continent.
Thank you very much indeed, Dr. Rutendo Hundringi, Founding Director of Tribe Africa Advisory, author of Rumble in the Jungle, Reloaded. Good to see what's happening across our continent. Bringing the time to 7:30.
The Money Show.
Personal Finance with Warren Ingram.
Well, with so much uncertainty swirling around at the moment ahead of Trump's big speech a little later today and, tomorrow morning, our time, I suppose I should say, and so many things changing so quickly, when better than to have a conversation about the personal finance rules we should know and we should follow. Warren Ingram, as you know, is a certified financial planner at Galileo Capital. Warren, good evening. You have an impeccable sense of timing. This is a very good moment to have this conversation.
I don't know what uncertainty you're talking about, Stephen. It seems everything's absolutely hunky-dory to me.
Well, thanks very much indeed. Okay. Okay, there are a few things that you've got to, and I made the point earlier, you've got to control what you can control. There are no certainties in life. So let's start sort of at the very beginning, shall we? One of your first points is that you need to pay off your expensive debt as quickly as possible. And on some level, this makes, complete sense. Very easy to understand.
So I think to your point about controlling the uncontrollables, when so much is uncertain, you need to try and build in as much flexibility into your financial position as possible. And one of the things that's extremely difficult to navigate or to negotiate is when you potentially lose your job, your salary gets reduced, or your income levels go down for whatever reason, and you owe banks, on a credit card or a personal loan or an overdraft, or even all of those together, and potentially a microloan, to boot. And so it's really important that when life is so difficult and so uncertain, that you try and get yourself as much breathing room as possible. And so I think focusing on your most expensive debts are key in this situation. And I often think, Stephen, that people make the mistake of thinking your expensive debt is the thing that costs you the most rands per month. So if you're paying 50,000 Rand a month on a home loan and you're paying 3,000 Rand a month on a credit card, you might be tempted to say, well, my home loan is my most expensive debt. And that's not true. Your most expensive debt is the thing that charges you the highest rate of interest every month. And, doing a quick search on what you could be charged on credit card debt, for example, at the moment, you could be paying as much as 21% a year on your credit card. To give you a context, if you don't pay your credit card debt off at all, it means that your debt will double against you every 3.5 years. So if you owe 100,000 Rand now, in 3.5 years' time, it will have doubled to 200,000 Rand. And unfortunately, there is no high-quality, reliable investment in the world that's guaranteed to grow at 21% a year or faster. So the answer is, pay off your expensive debt as fast as you absolutely can. And if you're in the position where you don't have that kind of expensive debt now, make sure that you do everything possible to stay away from those debts when life is so absolutely uncertain.
And I mean, it's also making sure you understand what your short-term, often your short-term, but what your expensive debt is. So that can be an overdraft or credit cards, store cards sometimes too.
Exactly, and I think it's worth going through your bank statements every now and then just to see what accounts you have open. Make sure that you're going through your emails to see who's sending you, what institutions are sending you statements, and do a credit check. A lot of the time on your banking app you can do a credit check for free. I think it's once a year that you can do a credit check. So just understand who it is that you owe money to, and then very importantly, go and check with them what the interest rates are that you're paying. They're obliged by law to tell you that. They're not allowed to say to you, we don't know. They're allowed to say, we'll come back to you, but they must tell you what that is. And then you rank those in order of interest that you're paying. In other words, who's charging the highest rate of interest. You do everything you possibly can to pay off the minimums on all the debt that you owe, and then you pay off much more on the most expensive debt first. So if it's your credit card at 21%, then you pay extra into that every month until your credit card's at zero. Then if it's your overdraft, which might be at 18%, you do everything you can to pay that down, and so on until you get to the point where you don't owe any money on those expensive debts, or as I would call them, bad debts.
Your home loan, we had a conversation about this recently, Warren. How can you sort of make, what sort of principles should you follow there?
I think it's, understanding that, these are personal finance rules for life. So understanding that by the time you get to retirement, you need to be entirely debt-free. And that then includes your home loan. So once you've hit your most expensive debts, your shorter term debts, the next thing to do is to look at the other debts that you might have. And most likely for a lot of us, if we don't have those short-term debts and those very expensive debts, we might have a home loan and we might have car finance. And so I might link the two in this point, is to say, make sure you are paying a bit extra into your home loan. The problem with money is we don't have an infinite supply. So it's not as if you can pay off everything all at once, or you can afford to double every single payment that's required on a monthly basis. You still need to live, have some fun, look after your family, and try and get through the month in a solid state. So what I would say then is try and prioritize getting your car debt down, but certainly you want to try and pay a bit of extra money into your home loan as well. And what it does is it gives you some additional breathing room, because if you do hit a financial wobbly for whatever reason, and you have been paying extra money into your home loan over a period of time, the likelihood is that you've built up some positive balances in that home loan as well, which might just come very handy if you do have to skip a payment or two. But you need to know what those extra values are before you just decide to skip a payment. But certainly, I would want to pay a bit more every month. And when interest rates are high, and let's say they're at, you're paying 11% or 12% a year on your home loan, the stock market might give you 12 or 13% a year. So when your interest on your mortgage or your home loan is nearly as high as the stock market return might be, it tells you that you need to be, focused on your home loan and get it paid down faster if possible. If interest rates drop, and there was a time when interest rates were nice and low, then you might be a little bit more patient and maybe not so aggressive on paying down your home loan. But at 12 or 13%, I would want to be focusing on this as well to get that paid down, extra money at least every month. You won't be able to pay off a 20-year mortgage, in 5 years, but you can give yourself a goal to say, I'd like to make a huge knock in it in the early days and try and get it done within 10 to 15 years.
And how would interest rates affect that? I mean, should you change your behavior according to interest rates?
I would. I think when interest rates are low, you can reduce your you're overpaying into your mortgage a little bit. So if we ever get to the stage where our home loans might only cost us 8% a year, and you know that stock market growth might generate you 12 or 13% a year, then you might start to balance that out to say, well, I'll keep paying a little bit of extra money into my home loan, but I'm going to direct a bit more money to my long-term savings and especially to the stock markets, because those are likely to give me, maybe 25 to 50% more growth than what I'm paying in interest on my home loan. And then when interest rates swing and they go up like they are now, then you would say, I'm going to maybe just do a minimum amount into my savings and rather pay extra into the home loan to try and get it down as fast as I possibly can.
You've got to manage your savings and your expenses, and I presume you want to actually increase your savings more quickly than your expenses.
It's one of those weird things that we do. When we start out, we earn nothing. If we hit the workforce, everyone pays us as little as they possibly can, and so we cut our cloth accordingly. In other words, if we're getting paid 10,000 rand a month, and that's what arrives in our bank account, on a monthly basis, then we make sure that we get by with 10,000 rand a month. But a few years later, if you're earning 15 or 16,000 rand a month, it's amazing how your expenses suddenly creep up to the same level, and that's a mistake that we make when we're starting to generate a bit more money on an annual basis. If you're lucky to get increases, what you need to do is say, if my salary's gone up by 3,000 rand a month, I'm not going to let my expenses go up by 3,000 rand a month. What I'm going to do is have a slightly better lifestyle. So I'll allow my expenses to go up by, let's say, 1,000 rand a month. But the other 2,000 that I now have breathing room with, I'm actually going to allocate that to my savings. And so, when you start out, you might not be able to save very much money, but every time you get an increase, you make sure that the bulk of your increase goes to savings, and then you do allow yourself a bit more money to have a bit better lifestyle. And if you keep doing that year after year after year, all the way through until your retirement age, what you find is that you end up living a better life than when you started. Your quality of life has improved, but you've been able to save a lot more money because you've managed to control your expenses and allow them to grow at a much slower rate than what your income has grown.
It's a very boring phrase, be sensible. That kind of is almost the very definition of it, isn't it?
It is, and it's funny when I meet people, especially high income earning professionals. Not to call them out and embarrass them, but the lawyers and especially the advocates, and then the doctors, and then especially the medical specialists, they seem to fall into this trap. You kind of walk around the workplaces where they are, and you look at their parking garages, and they're full of very nice cars. You look at their where they stay, and they live in very nice houses, and then you realize they're sitting on a lot of debt, and they've allowed their lifestyles to accelerate as their positions have improved, their titles have got bigger, and I'm not just picking on the doctors and the lawyers. I think it happens across the board, and that's fine if you want to buy those lifestyle assets, but you need to be doing that with cash, not with debt, and so I think it's almost a little bit of salary creep and expenses creep. We just do it because we don't really plan and we're not intentional about the way we spend. More money arrives in our bank account. We get happy. We reward ourselves. We reward ourselves the next month, and we don't ever actually plan to save more. So just do a little bit of planning every time you get an increase, and give yourself a bit of a reward, and then keep going. And common sense is a rare thing, and that's probably why so few people hit financial freedom.
I suppose. And look, feel free to pick on lawyers anytime on the Money Show. It's fine. You've spoken about this a little bit before, but having an emergency fund, I mean, clearly something that seems obvious. Very few people do. I often wonder if you have an emergency fund, shouldn't you just put it in your bond because it'll do more for you there?
You're a man of wisdom. I think it's a very good place to have an emergency fund. So if you've got a home loan, and to use the example, it's costing you 11% interest on a yearly basis, then taking extra money and putting in, let's say, somewhere between 3 to 6 months worth of your expenses and storing that in your home loan is a magic idea, because actually what you're doing by storing it in there, you're saving yourself an interest rate of 11% a year. So I would view it as almost as an investment that's giving you a guaranteed return of 11% tax-free. And the plan is that you shouldn't really want to spend that money. It is literally an emergency fund. So it is, the money that you draw on when let's hope it never happens again. But if there were another pandemic that arrives and we all have to shut down and people lose their jobs, that kind of major scenario that just comes from left field, you can't plan for it. So the way you can protect yourself and the way you derive some certainty in an uncertain world is have an emergency fund. If you don't have a home loan, or maybe you're not so disciplined with your savings, the extra money that you store in your home loan, then put it in a money market account linked to your banking profile, something that you can access in short order. If there's an emergency, you can't plan for it, so you might need the money quite quickly. But I just want to emphasize, this is not your holiday fund, your new phone fund, or your shoes or handbag fund, or whatever it is, your new shirt. This is really, honestly, for emergencies, and new clothes are rarely an emergency.
Okay, we've got a question from Mandy. Mandy is asking, we would like to start some investments for my children. What is the best way to do this? We'll have an answer for you in a moment, Mandy. It's a question we get fairly often. Warren Ingram, of course, co-founder of Galileo Capital with Personal Finance.
The Money Show.
Personal Finance with Warren Ingram.
Mandy's question for you, Warren. I'd like to start some investments for my children. What's the best way to do this? It's one of those questions that comes through fairly often.
You can tell we've got some great parents listening to the show, and I think the real key for me is probably the tax-free savings account. If you can set up a tax-free savings account for your children as early as possible, and even if you can't save the maximum for them per year, and the maximum we're allowed is 36,000 Rand a year or 3,000 Rand a month. So even if you can't do that, don't get disheartened. If you can only do 500 Rand a month or 5,000 Rand a year, it doesn't matter. Make that your starting point for building up an investment for your children, because you can open it in their names, and that's important because it's tax-free growth, it's tax-free money, and so by the time if you maximize that amount over their lifetime, and we're allowed to do 36,000 Rand a year up to a maximum of 500,000 for a lifetime. If you allow that to happen by the time they're 18 or 19, you've given them a major financial head start. And if times are tough and you've got friends and family who want to give your children a gift, every birthday or whatever it is, then just say to them, you know what, I would love you to contribute to their tax-free savings account. So it's a lovely way to allow the close friends and family to help contribute to your children's financial future, and you're doing it in such an efficient way. So yes, I think tax-free savings account are the one gift that keeps on giving, and just make sure that you try and choose something like a global equity investment or a JSE stock market investment. Please don't go and put it into a money market account or a fixed deposit. That's just not going to give a lot of growth.
So you need something that actually gives it a bit of booma, something that has a bit of an accelerator to it. Diversification. We all want a free lunch in this world. It's the only way.
It is the only way, and I think the too good to be true story with money seems to repeat itself over and over again. So many people get caught in scams, and even if it's not a fraud, just sometimes someone pitching an idea to you. I can't believe the number of people that are still thinking the only way to invest your money now is to just buy the 10 biggest tech shares in the world, and that will be the thing that will give you 15 or 20% growth a year. And the reason they say that is simply because that's what tech shares have done for the last few years. You need to know that whatever happened in the last 5 years, it's almost guaranteed that the past will not exactly replicate itself into the future. In other words, if 10 or 5 or 10 tech shares have done incredibly well for the last 5 years, it's almost certain that something else will do incredibly well for the next 5 years, and you don't know what that's going to be. And so the only way to protect yourself is proper diversification. In other words, make sure you've got an allocation to cash, to bonds, to property companies and to the stock exchange, and then make sure that you've got an exposure to South African businesses and assets as well as global assets, because none of us know exactly which country is going to do well. And I think it's very difficult when we're in a time like this, which is so uncertain, to just be relaxed and calm to say, well, I'll just keep carrying on. But the reality is you can't predict what's going to happen with trade wars. You can't predict what's going to happen with South Africa being targeted by Trump, if that's what he's doing. What we can do is we can back companies and we can back businesses to adapt to whatever's going on in the world and to then generate growth into the future. So I think proper diversification, where you've got somewhere around 25 to 75% invested overseas, and then making sure that you've got a solid allocation to global stock markets. And I think, if you're younger and you've got more time to invest, you can afford to go right up to around 75% in shares. If you're older or you've got a very compromised financial position, you probably need to scale that down, but you shouldn't have less than about 35% in shares. So the two rules of thumb around diversification is at least 25 up to a maximum of 75% overseas, and then at least 35% in stock markets up to around about 75% as a maximum.
And then you've got to know your financial freedom number, and you suggest it should be 20 times your annual expenses. I'm presuming that's annual expenses without children.
It's your expenses as they would be, at the point of retirement. So if you assume that your children are no longer financial dependents by the time you hit retirement, then by all means take the expenses for your children out of your expenses, but then include all the things that repeat on a infrequent basis. For example, if you buy a car every 5 years, then 1/5 of a car expense should be in your annual expenses. Don't forget your annual holidays, and then all of the groceries and rates and taxes and all the things that you pay today. Add that up, multiply it by 20, and that's most likely going to be the amount of money you need to have invested today to be able to fund your lifestyle when you hit retirement.
Obviously, you've got to work out what that is going to be yourself, and you've got to kind of also work out what that means for property, whether you've paid off for property, whether you're going to be renting, whatever it is. There's quite a lot of maths you might need to actually do to do it properly.
Well, yeah, I think if you're going to have a paid off house, then you would still need to include your property taxes, maintenance, etc. However, if you don't plan to own a house, then put in a rental number. The important thing is that you don't need to work it out in the future values. You do it in today's terms. So if you're paying 20,000 Rand a month in rent, then that's the number you put in for rent, and so you go for all of the expenses that you've got. And I think it's just tracking what you've done over the last, let's say, 3 to 6 months. That will give you a very good idea of what your annual number will be, and at least it gives you a target and a goal to work towards. You won't have it saved up today, but it's the thing you're aiming for.
Thank you very much indeed. Warren Ingram with Personal Finance on The Money Show this evening.